Hello everyone, in this video we will be doing the chapter 9 of ACCA F3, which is Intangible Assets. So before watching this video, make sure that you watch the previous videos. If you haven't, the links of everything is given in the description box below. If you want to solve the exam kit of Kaplan, even the links of that is also given in the description box below, wherein I am solving the entire exam kit. Also, before starting with this video, you need to have a paper, a pen and a calculator, and you need to solve the questions along with me, and you need to write and make notes. If you don't do that, you will not be able to understand anything, and then there'll be no point of watching this video. So this is a very easy chapter, and we will be finishing it in like a part itself, in one part only. So because we have already done what tangible assets are, this is going to be easy for us. So just follow with me, and if you have any doubts, you can drop them in the comment section below. Okay, so what is intangible assets? Now we all know what intangible assets are. So what are intangible assets? Something which we cannot touch. So tangible, the word tangible means touch, right? So what does intangible assets mean? We cannot see or feel. Basically, we cannot feel or touch. It's not about seeing, it's about we cannot feel or touch. So what are the tangible assets? Let's first discuss that. So you know what tangible assets are: machinery, paper, pencil, book, anything you can touch and feel. So what are the tangible assets of a business? Their machinery, their stock, their lights, their equipments. You can touch them, you can feel them. So they are the tangible assets of a business. Now, what are intangible assets of a business? What is something which a business has which we cannot touch or feel, but it is still an asset to the business? Talk about that. For example, patents, copyrights, goodwill. So all of these are intangible assets of a business. So what do I say? What do I mean by patent? If my company, if my business has got invented something very new, and if we made a new invention, so and I can copyright it, I can patent it, I can license it, and I can keep it. So now I can't really see what a patent is, I can't really see what a copyright is, but it is still there, right? And what do you mean by goodwill? Goodwill means reputation. So what do you understand by reputation? For example, let's take a big company like Nestle. So now everyone knows what Nestle is. And now let's take another XYZ company which is not that famous. Okay. So now tell me, people would want to, if Nestle wants to sell away its business, it will like sell it for like a lot of money. Why? It's because the business has a good reputation. Today I go to the market and buy products of Nestle because of its reputation, because of its brand value. So now I can't see its reputation, I can't measure its reputation, but it is still there. So all of such things which we cannot see, which we cannot touch, which we cannot feel, but it is still an asset to an organization. Such items, such assets are called as intangible assets. Okay. So now you know what tangible assets are, you know what intangible assets are, and IAS 38 speaks about the intangible non-current assets. Now you know what non-current assets are. What are non-current assets? Assets which are there with us for more than 1 year of time. They are known as non-current assets. Okay, what is amortization? Let's quickly discuss that now. Okay, if you can recall, in our previous chapter, we read something called as depreciation, right? What was depreciation? The wear and tear of the asset. You can recall, it was the wear and tear of the asset. Now we are learning a new word which is amortization, but there is nothing to be worried about here because depreciation is done for tangible assets and amortization is the wear and tear only, but it is done for the intangible assets. For example, if I have a patent which is costing, okay, give me a second. For example, let's say I have a patent which costs me $2,000 today. After 3 years, it is costing, if I sell it in the market, I will get only $1,000. which means the 1000 of amortization has taken place. Amortization has taken place, which means that my intangible asset lost its value. Okay, so amortization is basically the depreciation but of a intangible asset. This chapter deals with the definition of intangible assets before going on to consider how they are recognized and measured in the financial statements. Much of the content is new, but it is important. So, intangible asset, so it might come in a fill in the blank. Which IAS number speaks about intangible assets? It's 38. IAS 38 speaks about the intangible assets. Non-current assets are assets which are used within the business on an ongoing basis in order to generate revenue. Right. IAS 38, intangible asset, defines an intangible asset as an identifiable non-monetary asset without physical substance. So what I told you, you cannot touch or feel. If you cannot touch and feel an asset, which means it does not have a physical substance, it does not have a physical substance, and it is an identifiable non-monetary asset, which means I don't know how much exactly I'll get it right now, but I know that it is an asset for my business. In particular, the key characteristics of an intangible non-current assets are as follows. It is a resource controlled by the entity as a result of past events from which the entity expects to derive future economic benefits. Okay, so this is the definition of an asset only, right? It lacks physical substance, right? It lacks physical substance. You cannot touch it, you cannot feel it. It is identifiable and separately distinguishable from goodwill. Okay, so we in this chapter of intangible asset, we are not going to be talking about goodwill. So we are going to talk about the other intangible things which are not goodwill. So something like patent, something like what I said, license, something like all these things, brand mark, trademark, all of these things are the intangible assets which we can identify very, very easily. The basic principle of the recognition of an intangible asset in the financial statement is that the asset meets the. Okay, so how do you recognize an intangible asset? How do you tell how do you know that a particular asset is an intangible asset? Like, what is the basis using which you can come to a conclusion that a particular asset is actually an intangible asset? So the asset should meet the following conditions. The first one is that the definition of an intangible asset. We just read what the definition of an intangible asset is. So whatever asset we have to recognize, we need to see that, and we need to see if it actually matches to the definition of the intangible asset which is given in our IAS 38. Now, the recognition criteria. So the recognition criteria is what we will be studying in this entire chapter. So it should meet the IAS 38, which is, and the recognition criteria. Only when these two criteria are met, we can say that a particular asset is an intangible asset. As with any asset, it should be capable of reliable measurement, and it is probable that future economic benefits will be received over the useful life of the asset. So that's what we expect from every asset, right? We want some future economic benefits from it. So the same thing is required even from the intangible assets. Development costs are internally generated intangible assets. Okay, now first let's come and let's discuss two words which are extremely important. Okay, so now there are going to be two words which we have to study in the chapter. So let's just quickly discuss that. So have you heard of the word R&D? You must have heard about the words R and D many times. So you know what R is. R is research and D is development. So we always often use both of the words together, but we need to understand that there is a clear difference between the word research and between the word development. Now let's see what the actual difference is. So Research means we are just researching about something. We are, basically studying about something. We are trying to find information and we are trying to collect data regarding something. So this is something which is a prerequisite to development. Before developing a product, we need to research about particular things. We need to, like, kind of study and come up with the conclusions and all of that. So the things which we are doing before developing a new product, the research which we are doing, that all of those activities come under research. Now what comes under development? Development is when a new product is being developed, when the new product is developed. So when we actually invent something, and due to the research activities, if an actual new thing has been developed, that comes under development. For example, let's say there is a virus. Yeah, let's just take coronavirus. So there is coronavirus, and we, the scientists, have spent so much of their research in finding a salt, and they have done so much of research on where to find the salt, on which temperature to heat it. So all the research, like where do we use it, how do we use it, how to use the salt and everything. So this comes under our research. Now, using the salt, the scientists prepared a vaccine, or let's say a medicine. So this is when an actual item has been prepared. This is when an actual item has been developed. Development took place. Development of a new vaccine came into existence. A new medicine came into existence. An actual thing got developed over here using the research. So this is what is known as development. Understood about it? Are you able to understand what I'm trying to explain? You got the difference between what research is and what development is? Okay. Development costs are internally generated intangible assets which are capitalized provided that specified criteria have been complied with. They are considered elsewhere within the chapter. Okay. So what we have to understand is that research costs are always revenue expenditures, and development costs are always capital expenditures. Okay, remember that research costs are always a revenue expenditure, and development costs are always the capital expenditure, because development is when an actual product has been invented. Okay, so now these are the definitions of what assets are, and we have discussed everything. We saw what tangible non-current assets are, and we saw what intangible non-current assets are. So first, let's quickly go through what the tangible non-current assets say. So you know that a tangible means touch, which means they have a physical substance. For example, land, buildings, machinery, and anything which we can touch. So whenever you have a tangible asset, you know that expenditure obviously takes place, right? So cost of the tangible non-current asset is capitalized. So whenever you have a cost of a tangible asset, you capitalize it. If you can recall in our previous chapter, that's what we've learned. And depreciation is a reflection of the wearing out of the asset. Now let's come to what intangible non-current assets are. So they do not have a physical substance, right? They do not have a physical substance. We know that. For example, copyright, I told you. It can be purchased or may be created within a business without any expenditure being incurred, and it can be internally generated. So now, if I need an asset, I cannot just create it with absolutely no physical. If I'm talking about a tangible non-current asset, I cannot create a tangible non-current asset without using any materials at all, right? It needs physical substance. But when you're talking about intangible asset, for example, copyright, so in such situations, what happens is that it can be internally made, right? It can be made internally, and it can be internally generated. For example, the brands. Purchase intangible non-current assets are capitalized. Generally, internally generated assets may not be capitalized. Okay. So if I'm purchasing a copyright from someone, if I'm purchasing somebody else's business, if I'm purchasing somebody else's intangible asset, that is capitalized. But when my intangible assets are generated internally, in such situation, I cannot capitalize. Clear? Remember that. When I'm purchasing from someone else, I can capitalize it. When I am internally generating my intangible assets, in such situation, I will not be able to capitalize it. Amortization, we discussed what amortization is. Amortization is a reflection of the wearing out of the capitalized asset. So until and unless you actually capitalize an asset, till then amortization doesn't take place, right? You need to capitalize something in order for depreciation to happen. So what are the examples of intangible non-current asset? Development cost, goodwill, trademark, license, patents, copyrights and franchises. Let's come to the test your understanding one. Wills Limited purchased a patent. Give me a second. Okay, try solving this question and then you can discuss it with me. Willis Limited purchased a patent with a useful life of 10 years for 20,000 on 1st January 2009. Prepare extract of financial statements for the year ended 31st December 2006. So in statement of P&L, what happens? Just relate it with your depreciation chapter. In statement of P&L, we will show the depreciation expense. So in this situation, we will show the amortization expense. And in statement of financial position, which is our balance sheet, we will be showing the asset, which is our patent. We will show the patent. Right. So in statement of P&L, how much of amortization will you show? So it's the same, again it's the same formula which we have been doing in the previous chapter. What was the formula of depreciation per year? Cost of the asset minus the scrap value upon the useful life, right? And if scrap value is not given in the question, it means that the scrap value is 0. So what is the depreciation here? 20,000 is the cost. Scrap value is not given upon 10. So this is 2,000. So 2,000 is my depreciation. Now, in my statement of P&L, I will show amortization as 2,000. So what will be the value of my patent in my statement of financial position? Earlier in my statement of financial position, it was 20,000, right? But 2,000 of depreciation has taken place. Now what is the value of my patent? It was 20,000, but it has depreciated or it has amortized 2,000, right? So if you can recall it with the depreciation chapter, the same thing goes here. So what is the value of my asset or my patent today? It was 20,000. 2,000 of amortization has taken place. So now it is 18,000. Clear? No doubt. Now we come to what research and development is. So we have already discussed what research and development really means. Okay, so let's quickly just read it. IAS 38 contains specific requirements relating to accounting for research and development activities. First, it is necessary to understand the definition of research expenditure and development costs before their respective accounting treatment is considered. So we have already discussed what research means and we have also discussed what development means and we know how they work. Like we even took an example of the same. IAS 38 defines research as original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. So this is our definition of research. Now, what is the definition of development? It's the application of research findings. So whatever we have found used from the research, we are applying that to create a new product. To plan or design for the production of new or substantially improved materials, devices, products, processes, systems, or services before the start of commercial production or use. So, now let's talk about what the accounting treatment would be of the research and development. So, whatever costs are incurred in research and development, how do you actually account them is what we're going to study. Okay. So when an entity undertakes research and development activity, expenditure is incurred with the intention of producing future economic benefits, right? So whenever a research or development is undertaken, why does a business have to take up research and development? It does that so that a new thing can be invented or something new can happen, due to which the future income or revenue which we are estimating to be more, if we know that some decision will lead to increase in profits, that is why we take up some research, right? Obviously. So with the intention of producing future economic benefits, the accounting issue is therefore whether these costs should be expensed to the P&L or capitalized to the statement of financial position. So we need to check if whether we need to capitalize it or whether we need to just leave it as a revenue expenditure. Okay, so now here is the important part. So till now, I hope you understood the theory part. Now let us see how do you actually account for the research costs and development costs. So that is why I have explained the meaning of research and development and the difference clearly, because you might get confused in the questions, as into, like, you might not be able to understand which one is the research and which one is the development. But I hope it's clear for you now because we have discussed and we'll also be doing all the questions. Okay. So now let us see the accounting treatment of both of them. So accounting treatment, and I hope you are making notes of this because this is the most important thing. So how are you going to basically account for the research and development? So first let's talk about research. So whenever you have research, how are you going to account it? You will show it as an expense. You are supposed to show it as an expense, or basically expenditure. You're going to show it as an expenditure. And you are, so what are you supposed to do with expenditure? In statement of profit and loss, you're going to write it off, right? That's what you do with expenditures. What do you do with expenditures? You write it off from the statement of P&L. So whenever you have research costs, you are going to write it off from the statement of P&L, okay? And you are going to show it as an expenditure which has happened. Clear? So why are we doing this? If you go into the meaning of why we are doing this. See, today I might take up a research for my business. I'm not sure if the research will work or if the research will not work. I might have a research for a product. Okay, let's just take that coronavirus salt example. I might incur research costs and maybe the salt will not work. Maybe the salt was a failed business idea. It can be possible, right? So we are not sure that research costs will cause business operating activity cash inflow. We can't be sure of that, right? So that is why we show that the research costs are to be written off in the statement of P&L as an expenditure. Now, if I buy a, let's say, machinery, or if I buy any other asset for the purpose of research, that asset will be capitalized. Clear? So whenever I have an asset like a machinery, or when I buy any when I buy any non-current fixed asset, only those assets will be capitalized. No doubt. So whatever research costs have been taken place, whatever research expenditure has been taken place, I write it off from the statement of P&L. But if I buy a fixed big asset, if I buy a fixed non-current asset for my research purpose, that asset should be capitalized. And so that's how we are going to go about research. Now tell me, What do you think happens with development costs? So, what happens with the development costs? What are we supposed to do it? So, in short, we are supposed to capitalize it. We need to capitalize it. What does capitalizing mean? Showing in the statement of financial position or the balance sheet, right? But provided we need to capitalize the development costs, provided some of the conditions have to be met. So there are some conditions which we will study about, and if those conditions are met, then we can say that a particular thing is a development cost, and if it is a development cost, then we can capitalize it. If some development cost does not meet the conditions which we will study about, then it has to be written off in the statement of P&L only. Clear about it? Now let's read the theory, whatever we've studied so far. So we studied about research. All research expenditure should be written off. This is what we studied to the statement of profit and loss. This is in compliance with the prudence concept. You remember what prudence concept is? We have done it in the first chapter. If you haven't, then go and watch that video. Research expenditure does not directly lead to future benefits. Therefore, it is not possible to follow the matching concept. That's what I have explained. That we can't be so sure now. We can't be sure that the research will be successful. We can't be sure that it will give us future benefits. So that's why we cannot capitalize it. Any capital expenditure on research equipment, so I told you about the machinery, property, or any equipment which we purchase for the purpose of research, that should be capitalized. So that is the only thing which needs to be capitalized. Like plant and equipment, anything which we buy as the research equipment for the process of research, such things only should be capitalized. Okay, normally, like we studied in the IAS 16. What happens in development cost? According to IAS 38, intangible assets, development costs must be capitalized as an intangible asset if they meet the definition of an intangible asset and also meet the recognition criteria. So, if some development cost is there, and if that development cost matches these criterias, then what will we say? Then we will say that it is an intangible asset. Okay. So, what are the criteria which an intangible asset or a development cost must meet in order for it to be capitalized? So, remember the abbreviation pi rate. Okay. So, P for probable inflow of economic benefit from the asset, whether through sales or internal cost savings. So, if whatever the thing is, there should be a probable economic flow in the future, which means that whatever development cost is, that should give us income in the future. Okay. Next, we have intention to complete the asset and use it or sell it. So whatever development we are working on, we need to have an intention that we will be selling it in the future. We will be earning revenue from the future, right? Reliable measurement of the development cost. So we need to be able to reliably measure the development cost. Only then we can recognize it. Adequate financial and other resources to complete the project. So whatever development we are undertaking, we need to have all the financials which are required. Technical feasibility. So technically it should be possible to develop such an item, right? Expected to be profitable. Obviously, whatever development we are undertaking in our business, we take it only if we expect it to be profitable. So yeah, if the above criteria are met, development expenditure must be, okay, wait, give me a second, let's first read this first. No, never mind, let's just read that. If the above criteria are not met, if the above criteria are not met, then development expenditure must be written off to the SPL. Okay, so if these definitions, the pi rate definition is not met by the development cost, that means it is not a development cost, it is a research expenditure, and we have to write it off from the statement of P&L the way we did for research. But if the development cost matches the pi rate criteria, that means it should be capitalized, it is an intangible asset. If research expenditure has not been treated as an expense, it cannot subsequently be reinstalled. If a research expenditure has been treated as an expense, it cannot be subsequently reinstalled. Okay, so when you have a research expenditure, or even though it's a development expenditure, in the past you have written it like a research expenditure. Then suddenly from this year, we can't start changing it into a development. Okay. Subsequent treatment of capitalized development expenditure. The asset should be amortized over a period that it is expected to benefit. Okay, so whenever any asset meets the or whenever any asset or whenever any development cost meets the pay rate criteria, that means that it is an intangible asset. If it is an intangible asset, then amortization takes place, right? On tangible assets, depreciation takes place. On intangible assets, amortization takes place. So whenever we have development costs, when it matches the pay rate criteria, we say that the development cost is an intangible asset to the business. Clear? So whenever we have a development cost, we have to amortize it. Amortization should commence with the commercial production and charged over a period. Okay, so what is period? Period is the useful life which we have been studying only. Okay, and if an asset has been used for the useful life, you know how to use the useful life to calculate depreciation. That is the same way using which you need to calculate the amortization as well. Each project should be reviewed at the end of the year that pay rate criteria are still met. If by the end of a year the pay rate criteria is no longer met, then the previously whatever capital expenditure was there, it must be written off. Clear? Okay. So now this is what is about amortization. So let us quickly see the formula. It is the same as the depreciation, don't worry. Amortization for per year. Amortization per year is basically cost minus residual value upon useful life. That's what we have been seeing. Now what will you do? You will have the development cost. You will be having development cost divided by useful life. Clear? It's the same definition. You need to basically write the development cost and divide it by the number of useful years. Pause the video and read this. Okay, so now let's quickly solve this question and see what it's saying. So the cost do not qualify for capitalization. So first we need to say that whatever development costs are there, they do not qualify for capitalization. If it does not qualify for capitalization, does it mean that it is an intangible asset? No. Why? Because pay rate criteria has not been met. If pay rate criteria has not been met, it means that the development expenditure will not come to the statement of financial position. It will be written off in the statement of P and L. So in my year's profit, I will write it off. Clear? So this is my 2005. This was my revenue. This was my development cost. Since it cannot go to statement of financial position, I will do my net profit, which is plus 400 minus 900. My net profit is 500, and other years it's going to remain the same. Now let's see the B part. The costs do qualify for capitalization and are amortized on a straight line basis, which means my 900 becomes an intangible asset now. Why? And it qualifies for capitalization. So I have to amortize it. So what would be the amortization value? 900 divided by what is its useful life? 3-year period. So 3. What is 900 divided by 3? 300. And it has been used it was used from like the year 2016 for 3 years. So 300 is my amortization per year. Clear? So from 2006, 7 and 8, every year I need to minus 300 as my amortization. everything else remains the same. This will not be here anymore. Why? Because every year you are amortizing it from when you started using. Why am I not subtracting in 2015? Because they started using it in 2016. So let's see, everything remains the same. What they did, the development costs are amortized this time, right? So you know how to find it. So 300, 300, 300. Now here development cost is not there now. Why? Because we are following the capitalization rule. So in 2015 we have 400 plus 0, which is 400. In 2016 we have 500 plus 450 minus 300, which is this, and the same way here and same way here. So I hope it's clear now. Okay, so now pause this video and read the question and tell me which one is a development cost. Keep in mind the development cost should meet the pie rate criteria, which means that there should be a motive of generating profit, there should be an intent of generating revenue for the business, right? It's not just researching about something and leaving it. There should be a reason for the research, there should be a motive of earning a profit. So the answer is C, which is 2 and 4. Why? Because they are using the research to create prototype here. Here they are using it for making a waterproof. Whereas in 1 and 2, read it, they are just finding something. They are just finding something. But they are not telling us why they found it and are they using it for a business motive. During the current year, Deep Blue Sea developed a new material from which the next generation of wetsuits will be made. This special material will ensure that swimmers are kept warmer than ever. The costs incurred meet the capitalization criteria, which means it is a development cost, which means it meets the pie rate criteria. And by the 31st December, 250000 have been capitalized. So what is my development cost? My development cost is $250,000. This also meets my pie rate criteria. What does that mean? This is an intangible asset. I will assume it to be an intangible asset. Why? Because it is a development cost and because it met the pie rate criteria. So which means I have to amortize it now because it's an intangible asset. So let us amortize it. Let us find for how many years it is used. The wetsuits are expected to generate revenue for 5 years. So 5 years is my useful life. So how to find amortization per year? Cost divided by useful life, which is, so 50,000 is my amortization per year. Amortization is always a negative. You subtract depreciation, it is a loss, right? You always remove depreciation, you remove amortization, it is a loss. So in 31st December 2016, what is in my balance sheet? I mean, what is in my P&L account? You have a loss of 50,000, right? Every year you have to minus 50,000. So in 2016 also you will minus 50,000. So my answer is D, 50,000 amortization. Okay, so measurement of intangible assets. So we know how to measure intangible asset. We know how to recognize them now. We have done all the questions. So these are the definitions. An intangible asset should be measured initially at cost. So we need to obviously measure the intangible asset in cost. So this, you know, that cost minus accumulated depreciation will give you the carrying value. So fair value should be measured. So these are the IAS 38 disclosure requirements. So these basically talk about what all disclosures have to be given, and this you can read by yourself, which method you are using, what is the reconciliation, what is the amortization during the period. Okay, so now we have what the balance sheet looks like. So this is something, we have the cost, we have balance of everything, we have additions, then we have removals or disposals, and then we have balance, Then we have accumulated depreciation, and then we have what the charges we have. So this is not something which is that important. This we'll be doing in the last chapter anyway. So that's it, we are done with the chapter. Just make sure that you know what you need to do with research cost and what you need to do with development cost. So research cost, we will show it in the statement of P&L and we will write it off as an expenditure. But if we used some asset or any research equipment for the purpose of research, that only that will be capitalized. And what do you do with development expenditure? Development expenditure is capitalized. When is it capitalized? It is capitalized if it meets the pi rate criteria. If it meets the pi rate criteria, then you will capitalize it, which means you will consider the development cost to be intangible asset, which means you have to amortize it every year. And in every year, what will you do? You will divide it by the useful years. So if you still have any doubts, you can go and watch this video again. So that's it, we are done with this chapter. Check out the description for the Kaplan exam kit videos as well. And I will be solving the exam kit of all chapters also. One part has been uploaded, but you can check the description box below as and when new parts will be uploaded. Thank you.